G'day everyone, welcome back to Pete's Investing. Today I'll be talking about the Commodity Channel Index on the 14 time frame. We're looking at the percentage gain and drawdown requirements to buy and sell. First of all, if you haven't already, subscribe to the channel, hit the notification bell to get updates, and go to our strategy playlist, and that's where we look at all the strategy we cover each time we put out a video. We're not offering financial advice, it's purely an educational series. So let's get started. What we're going to cover is the entry strategy, obviously. There's thousands of entry strategies we can use, and we're going to be using the Commodity Channel Index today. We're going to show you a simple exit strategy. There's a lot of videos out there that show how to enter a trade, but they don't really tell you how to get out of a trade profitably. This strategy we use is a profitable exit. Look at the average down strategy. Now, we don't use stop losses. I don't see any value in those. You only do use stop losses if you're going to be gambling. And in our strategy, we don't gamble. We look at some effective approach to invest your money and get profits in a consistent manner. We've backtested our results on stocks on a daily time frame. We've also looked at it on indices using CFDs on a 15-minute time frame and Forex on a 15-minute time frame. We explain the drawdowns or the drawdown approach or the funds required, how to invest in this, and today we're going to be looking at stocks to see how they've performed over the more recently since the Russian-Ukraine crisis. And lastly, we look at the average revenue estimated returns over the time period. And just very quickly, some of my investing rules. We only buy proven blue chip stocks, avoid speculative stocks. We buy stocks which pay dividends, and dividend returns we're looking at anywhere between roughly 2 to 5 or 6% returns on dividends. I'll explain why dividends are important in the charts. We can show those. We don't short positions, although you could, and the main reason we don't short positions is when you pay dividends. Let's say we're trading with CFDs. When you go long, you receive dividends. When you go short, you pay those dividends to those people that have gone long. So if you're held in a position for a long extended period, as well as any holding costs, you're also going to be paying out dividends if you go short. So we go long only. And lastly, don't trade on any news. Price has already been factored in the share price. So anything that's going to happen in the news is already historically proven to be ineffective in terms of buying. First of all, let's look at our entry and exit and average down rules. Again, we're using the Commodity Channel Index in the 14 period time frame. This is on the daily chart. So when the CCI 14 breaks above zero, we enter the trade. Again, this is a very simple entry and exit strategy. We exit the strategy when the close price has gained at least 5% gain. We get out of the trade. So if the price goes in our favor and you're going long, we exit when the price reaches at least a 5% gain. We average down when the close price drops by at least 10%, and our CCI 14 breaks above zero again. So again, I'll show you and explain this in the charts. So what that looks like. First of all, let's look at the Commonwealth Bank of Australia, and then what we're doing here as well, we're looking at a set parcel of shares which have been trading, back testing, I should say, in our trades since the start of 2007. Now, the reason I'm showing you since the start of 2007 is I want to show you the effects of during the GFC that happened back here between 2008 and 2009, how that impacts our trades, and also importantly during COVID, and that's the big drop there in this particular share price chart. So we're testing and back testing back to the start of 2007 to see the big impacts of our profitability with GFC and COVID effects. Very simply, again, with our trading strategy today, we're looking at entering when the CCI 14, and that's the Commodity Channel Index down here, when the CCI 14 breaks above zero, we enter the trade. Now, I don't particularly care when that time period is. You can see here, these are all the trades, entries and exits. Entry and exit, entry and exit. Here we've entered here, the price has gone against us, and then we've averaged down and we exit. So again, very simply, we enter the trade when the CCI 14 breaks above zero, we buy. And we exit. You can see there I put a little ruler when the share price gains at least 5%, we exit. So that's our little return. And again, we're trading here on $2,000 lots. So now every time we buy $2,000 lots of these shares. So here, for example, the share price back there at close was $99.13. So we buy $2,000 worth of that particular share price, and we exit that at that point there when the 5% gain is reached. And here you can see the return on that little trade. And our baseline, we'll start at $100,000 as our baseline. You can see there that the close was 4859 in terms of dollars. We started with 4744. So we made about $90 in our little trade there. Another trade here was entered. CCI 14 breaks above zero. We buy, and we exit when a 5% gain is made. Now you could use there's a few other exit strategies you can use when moving averages break down, but you can see here as an example, this is the start of the Ukraine crisis. The share price plummeted, and you would have been back below our starting point had you bought and traded on the moving average. So in our 5% gain strategy, we would have got out with a nice little return again. Here, the CCI 14 breaks above zero again. We buy, and the share price is now moving against us. That's okay. We're going to follow the moving averaging down approach. Let's go to our next. I just want to quickly show you how the share prices of our parcel of shares has performed with the Ukraine crisis. So again, back here, buy and sell. CCI 14 breaks above. Now it just happens to drop below that. The 5% gain was made there. We buy more there, exit, buy more there, exit, and we bought another lot of shares there. So again, the buy and sell strategy is working in our favor in this case. Now, for those that want to sit on the share price, you're buying for a long term. The only time the buy and hold strategy works, and that's where you buy and not sell, is when the share price does this and it goes consistently up. But if the share price goes in a roller coaster fashion like it is here, the buy and sell strategy works more effectively. Let's quickly look at Caterpillar. Again, you can see here, share price is doing nicely. If you held it, and then it started going against us. So here you would have bought one lot there, bought another parcel of shares there, and a third lot there. So here you would have invested $2, $4, $6,000 worth of shares in this trade. And then you finally would have broken out once that average of those three trades was reached, the 5% gain of the average. You can see there the three lots of shares was sold. So we started here, profitability 8,989. We closed out 9,281. So a few $100s in the return made there. We're coming close to probably on this opening of this week. We're going to probably come and close and buy another lot of shares here, because you can see here it's almost breaking above the CCI 14. Johnson & Johnson. Again, you'll notice here out of the parcel of shares we're testing, I've bought a couple of Australian shares, a couple of US shares, and a couple of European shares, just to give you a bit of a range. And we've been trading these shares since the start of a couple of years ago. Again, single entry trades made in Johnson & Johnson, buying and selling. And here we're in the trade here with this particular position open at the moment. Now, you'll notice as well, we don't buy unless the share prices drop below less than 10%. I'll show you an example of that. Another lot here, buying and selling single trades, and we bought a second lot of shares for JP Morgan here. That's going against us, but again, follow the strategy. We'll show you the results of in the coming weeks. So Telefonica, these are the European shares. Okay, this is a good example of the averaging down and buying solid dividend stocks. What you notice here is each of these points, that's where we bought our first lot. You'll see there's historical dividend payment made, another dividend there. So each of these green arrows indicates where the dividend was paid. So even though we held this stock for quite some time, since 2016, we've been receiving dividends in the meantime. So we've averaged down, we bought one lot of shares there, another lot there, another lot there, and so on. So we bought quite a few shares and invested quite a bit of money in this particular trade. But in the meantime, we would have received these dividends along these periods where these green arrows indicate. And just to give you an idea of the profitability, we opened up in that particular trade, 2732. We closed out 4609. So it did quite well, even though we've invested quite a bit of our money in buying those multiple shares. And that profitability, by the way, doesn't factor in the profitability from all the dividend returns. So those dividend returns would have been on top of that profitability. And lastly, Volkswagen. Okay, now to show you the last couple of, you can see here, we bought one lot of shares there. We averaged down, and the second lot of shares there, and the price is going against us. But again, we're going to keep following our strategy. So that's our entry and exit and average down rules. This is a chart showing, or the table showing, the profitability since the 1st of January 2007. Again, we're factoring in GFC and COVID effects, and now more recently the Ukraine-Russian crisis. And yesterday's date was the 5th of March 2022, and this shows you the profitability since the 1st of January 2007. Number of contracts held, so every time we buy the number of shares in this particular parcel of shares, that's the number of contracts we held or number of shares we bought. Each time we bought $2,000 lots. The maximum drawdown is simply from the highest profitability to the lowest point of profitability. So that's our profit, the drawdown plus contracts. So it's basically 8 times 2, which gives us 16,000 invested in that in any one particular time. And the drawdown was the highest profitability to the lowest. So again, just very quickly looking at CBA, should demonstrate that example. So going back to the start of 2007, so 4871. So 4871 was our profitability. We bought 8 lot of contracts, or 8 bunch of shares. So that would have been 1, 2, 3, 4, 5, 6, 7, 8. Actually, would have been 9. So that's a bit of miscalculation on my behalf, but much of a muchness. So 9 times 2 would have been 18,000, and the maximum drawdown was 5810. And the maximum drawdown is simply from that point to that point in terms of profitability. So if we draw a ruler from a rough, and again, just drawing this, eyeballing it, is 5423. That's just with it roughly drawn in that little example. But using the software, detailed report, 5810 was our maximum drawdown. That's what we use as our official figure. So you can see there, they're the respective drawdowns of each of those lots of shares. And what I've done there is calculated the total number of months since 2007, and that's our average revenue per month. So if you wanted to invest more and get a higher monthly return, you simply invest more per a lot of shares you buy. So you would have bought, let's say you doubled that, you bought $4,000 lots, then obviously that's going to be 9 times 4, 36, plus the drawdown would have been higher as well. So that would have raised your drawdown for each of those, although it would have also given you a higher monthly revenue. Again, these figures don't include dividends. Okay, don't forget to hit the subscribe button, the notification bell, and review the strategy playlist. And thanks for listening, and we'll see you in the next video.